Welcome to HowStreet.com video. I'm Stirling Faux in conversation with Eric Coffin from HRA Advisories, publishers of the Hard Rock Analyst. Welcome.
Thank you for having me.
Lots of buzz about gold these days. I want to come at you on gold in a slightly different tack, referencing something you've written about lately. Okay. How or why would changing the price of oil from US dollars to euros or somebody else's currency benefit gold?
It benefits gold. Essentially, it's part of an ongoing process. I mean, Dave and I have talked about the end of empire scenario, if you will, for several years now. If you look at Britain, you look at Germany, you can go back, look at France. There's a whole number of countries that have gone through this where you get to the point where you're a large empire, you're the dominant political power, your currency is the reserve currency. I mean, before the US dollar, it was the British pound. I don't think it's coincidental that most of these empires, if you will, quite often it's overextension militarily in the past was often what ended it, but in the last 2 or 3 go-arounds it was really debt. I mean, it was overextension financially. I think you can make the argument the U.S. has gotten to that point, and I think because of that, you've got what we refer to as the creditor nations, countries like Japan, China, that have large foreign reserves. You know, obviously the U.S. is the biggest economy in the world. I mean, you know, it's still the lead dog, but you know, our sense is in terms of being the primary player, it's, you know, the sun is starting to set, and I think people on the other side of that are saying, look, we're not very comfortable with the U.S. being the reserve currency, pricing our imports and exports in that. And if you look at a country like China, I mean, obviously the States is their biggest customer, although we think that's going to shift over the next 20 years. But they've got $2 trillion in reserves, and a lot of those are in U.S. dollars. They've lost a lot of money on that in the last 10 years, like a lot of money.
So is there a percentage of likelihood that this transition in the price of oil into some other currency could come about?
I think it probably will come about. I don't know whether it's going to happen overnight. I think you know, if you look at Iran, and obviously Iran, I mean, the guy running Iran's a bit of a wingnut, and he's got his own reasons, political reasons for doing things. He's already taking essentially all of his payments in euros. The thing with currencies, the reason why currencies, and we've viewed a lot of the move in the gold price as being a currency move, if you will. It gets tricky because the thing with currencies is you can't really view them in isolation. It's always a pair trade. There's no such thing as sell a dollar. So, well, okay, when I sell a dollar, what am I buying? Like, it's, you know, it's not a one-way street. We think part of the reason why gold is strong, it's not just because the dollar's weak, it's the other side of that pair trade, and it's a currency, if you will, that people are comfortable with. I think you're seeing more and more guys saying to themselves, look, why don't we just work around the US dollar? Because at the end of the day, if the US runs into real trouble, if we're getting more and more reserves in other currencies and trading outside of the US dollar, I mean, we've just got more flexibility. I mean, China's already doing that now with Brazil. There's talks ongoing about them doing their trade, and if you look at Brazil and China, Brazil's a huge exporter of iron ore to China. I mean, it's really big dollars. It's not chump change. They're probably going to switch that to yuan and reals. In order for it to really get to the end game of this, I don't see it happening unless China is willing to actually really make a fully convertible currency, and frankly they've got to be willing to let their currency appreciate, which they haven't really been willing to do. China still sort of has that exporter mentality. I think they have to get past that and say, you know, it's time for them to kind of suck it up and let their own currency go up 20 or 30 or 40%. It's good for their people. It generates a lot more consumer spending internally, and that's when I think that's when you'll really see the dollar sort of do, I don't know if it'll be the final slide, but it'll probably slide farther. But at the end of the day, it's better for everybody. The one concern we've had, Dave and I were pretty early saying, you know, we think the market's turned, it's time to get back into some stuff. If there's one overriding concern we've had for the whole year, and I still have it, it's that the U.S. has to sell a lot of paper. I mean, they have to sell enormous amounts of debt. I mean, next week is another record for Treasury auctions. The amazing thing, and it is amazing, it amazes me, Bernanke's been able to sell this much paper without really having the yields go up. I mean, it's impressive. I mean, a lot of guys don't like Bernanke. I'm amazed that he's pulled this off. Mm-hmm. And the one thing I always watch for, we watch the Treasury yields all the time, because that's, if you're really going to see trouble short term, that's where you're going to see it. You start seeing the 10-year rate suddenly do this, like, look out, because things could get a little nasty in the market. But as long as the U.S. is able to sell those treasuries at low yields, which they've been able to do, there's no upside for them to have a rising currency. It's not in their interest. I
want to change gears on you, Eric, because we don't have all the time in the world, and you have a keen eye on undervalued, asset-based precious metals companies. Do you think there's some catch-up room to be made here? Significant room for investors along with these companies?
I think there is. I mean, really, there's two ways to go at this market. One is you either go after the big companies, in which case you're basically playing the changes in the commodity prices. And I think some of the larger producers, the well-run ones, they haven't really run that far. If you take a look at what the gold price has done, really, if you look at the gold indexes, they haven't really seen the rise on the market. The gold market indexes, they haven't caught up to the gold price yet. So there's still room there for upside. But the other thing, because of the amount of liquidity that's come into this sector again in the last few months, essentially success is being rewarded. I mean, companies that go out, find a good project, put some drill holes in it, get some good results. I mean, we're finding they're getting very good gains. I mean, we've had several companies that have done really well this year. Basically success is being rewarded again, which it wasn't for a couple of years. I mean, the market was so ugly, you could put out the greatest drill hole in history and people just yawned.
But you also talk about commodity prices coming too far too fast.
The base metals, I mean, we'd be a lot happier to start seeing the inventories in terms of the amount of copper or zinc or lead that's on inventories in the London and the Shanghai metals markets. I'd be a lot happier seeing that sort of tail off. Because with base metals like gold and silver, like oil, like all commodities, they've had a currency move too. I mean, given that the copper inventories have actually gone up about 100,000 tons in the last month and a half, if you'd asked me a month and a half ago and said, okay, the copper inventory is 450,000 tons, is copper going to be at $3? I'd say, no, forget it, no way. 2.25 maybe? It's at $3. But that's because it's also getting a currency move. Like, all of these things are getting a currency move, and you have to remember that when you're trading this stuff, we're very, very, very comfortable medium and long term about metals and base metals. I mean, we think we're in the early part of a long secular cycle, but we are seeing moves right now that are essentially anti-dollar moves, and you've got to keep that in mind. You can't take your eye off the U.S. dollar index because these things are trading against it.
Well, take a second and sort of project that onto the Canadian economy as a whole, given that we are as strong a resource-based economy as we are. How does that bode for the overall Canadian economy?
I think Canada's one of those economies that's going to be, a big winner this cycle. I mean, it's funny. I mean, 20 years ago, 30 years ago, it was, oh my God, hewers of wood, drawers of water. I mean, how much boring can you be? You can't make any money at that. Well, we're going to make a lot of money at that, actually, the next little while. The downside of that is, I talked about currencies always being a pair trade. The buy side of a lot of currency trades lately has been the Canadian dollar, the New Zealand dollar, the Aussie dollar, because our economies didn't really get hurt that badly because we're resource producers. The bad news, of course, is if you're a guy in Ontario making Chevys, you don't really want the Canadian, you don't want the loonie going from 80 cents to $1.05, and unfortunately I think that's probably what's going to happen.
You wanted to talk very briefly about the Hard Rock Advisor, the newsletter. You've got some deals going on here.
Yeah, I wanted to make a mention. We do have a special offer that it'll probably run a little bit into November. You'll be able to find it if you click on our banner on the HowStreet.com website.
Okay.
Essentially, it's a page you can go to, gives you a little bit of information. If you put your email in, there's an autoresponder. You'll get a package of recent issues for free. There's also a fairly large saving on subscriptions if you want to take advantage of it, but at the very least you get some very recent, very free stuff.
We'll have more from Eric Coffin and David. Maybe next time we'll get the two of you in the room.
Yeah, he wasn't dressed for it today.
We'll learn more about the future plans for HRA Advisories. And Eric, thank you for coming in.
Thank you, Sterling.
Comments made on How Street Video and HowStreet.com are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at HoweStreet.com. Howe Street Video is a production of Howe Street Media Incorporated.